Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey, everybody. Thanks for joining us. I'm Dr. B with John G. Ullman and Associates, and this is our weekly market update for the week of February 24th. I want to thank you for joining us. Also, if you find this content helpful or informative, make sure you like and subscribe below. And don't forget to take a few minutes to check some of the other great videos we have on our page. As always, the point of these videos is for me to use my background and expertise in economics to help you understand what's happening in the economy and in the financial markets so you can make informed financial decisions. So with that in mind, let's get ready to hit the books and get up to speed on the markets. So as usual, we'll start with last week. And of course, the first topic is tariffs. The newest addition to our tariff regime is the Trump administration adding tariffs on cars, pharmaceuticals, semiconductors, and lumber. These are rumored to be 25% tariffs, scheduled to begin in April. Shifting our focus to inflation, we saw manufacturing surveys out of the New York and Philadelphia Federal Reserve, as well as a report on economic conditions from S&P Global, all three of which show fading optimism and growing concern around inflation, tariffs, and the job market. Specifically, in all three reports, we saw increasing input costs and increasing reports of prices charged to manufacturing customers. Along with concerns about growing inflation, we're also starting to see growing concerns in the housing market. Sellers seem to have grown impatient, waiting for interest rates to fall, and more houses are hitting the market every day, while buyers seem to have realized that 7% mortgage rates, combined with historically high prices, are just simply pricing them out of the majority of houses that are available. Along those same lines, we saw existing home sales data last week, which demonstrated that home sales in January fell by about 5%. And we saw the National Home Builders Association Housing Market Index fall by a significant amount for the month of February as well. Home builders are currently struggling with low temperatures, as well as dramatic concerns about tariffs, high interest rates, and labor shortages. Switching from the housing market to the consumer sentiment report, last week we saw the final February consumer sentiment report out of the University of Michigan, and it aligned pretty closely with what we had seen in the preliminary report 2 weeks ago. The one area where we saw a deviation was in long-run inflation expectations. Although the 12-month inflation expectations increased as predicted from 3.3 to 4.3%, which is the highest level we've seen since November 2023. The big disappointing surprise was that long-run expectations had increased from 3.2 to 3.5%, which was significantly higher than the preliminary data had suggested. Unfortunately, what this tells us is that it's possible that consumers are starting to see their long-run anchors, as far as what they expect inflation to be, rising at an incredibly fast speed. And as these anchors become undone, the possibility for future inflation and higher expectations grows significantly. Taking a look at the stock market, it was a tough week as all three major indices finished the week down. It was also a short week as the markets were closed on Monday for observation of the President's Day holiday. The markets actually showed a small amount of growth throughout the week until we arrived at Thursday and Friday. Unfortunately, the big drops on Thursday and Friday ensured that all three indices lost value for the week, with the Dow Jones Industrial Average leading the way, and all three indices losing at least 1.5%. Some brief explanations for why we saw the pullback on Thursday and Friday. Thursday was mostly related to Walmart, who released fourth quarter earnings, which were better than expectations, but also released increasing concerns about consumer spending in 2025. They explicitly mentioned increasing tariffs and the potential for increased inflation, drawing consumers away. On Friday, we saw the market start to dip early in the morning in response to the existing home sales data falling, but we saw the drawback really exacerbated later in the day as the consumer sentiment reports came out and growing concern for inflation seemed to take hold of the markets. Yields on the 10-year Treasury note rose throughout most of the week, but on Thursday and Friday they dropped back down to about 4.4% by the end of the week. Also, we saw Bitcoin continue to operate within a relatively tight window of prices, ranging from $94,000 to $98,000 per Bitcoin. Taking a look at some of our alternative markets, the price of crude oil rose throughout most of the week, but then, along with the stock market, took a significant dive on both Thursday and Friday, ultimately leading to a weekly loss, which in fact was the fifth straight weekly loss for the price of oil. We saw the value of the dollar rising and then falling slightly throughout the week, ultimately ending the week a little bit lower. And last of all, we saw the price of gold rise rather steadily throughout the week. Although on Thursday there was a slight pullback, the price of gold ended the week higher. Switching our focus to this week, we continue the fourth quarter earnings season, although we are quickly approaching the end of earnings reporting season. This week's reports will include about 50 of the S&P 500 companies, and the headliner is tech giant NVIDIA. We're also going to see some consumer giants reporting, including Home Depot, Lowe's, Dell, HP Computers, and eBay. Also this week, the story that won't die. We'll see more inflation data towards the end of the week as the Personal Consumption's Expenditure Price Index, also known as PCE, will be reported. The PCE happens to be the Federal Reserve's preferred inflation measure, and given their interest rate decision in March, this report will probably be one of the most impactful on that decision in general. We also see analysts and economists in disagreement as to whether this report will be higher or lower. Some analysts suggest that based on the CPI data, this PCE report could be a bit lower, while other analysts suggest that data from the Producer Price Index suggests that this report may be slightly higher. Unfortunately, only time will tell. Wrapping up the economic data for this week, we'll see some home price data early in the week. We'll also see the second estimate for the fourth quarter gross domestic product. This could be an incredibly impactful report because the initial report had GDP growing at 2.3%, but the data that's been released and analyzed since that report suggests that we could see a significant upwards revision to the fourth quarter GDP estimate. Looking further into the future, of course, we have tariffs and inflation playing the main story. Seems as though every week we get a new tariff announcement. And at this point, as we approach the month of March, we also see a potential for the resumption of 25% tariffs on Canada and Mexico. At this point, the markets seem to have taken all of the tariff announcements in stride, demonstrating some apprehension, but ultimately looking to wait until they have tangible evidence that these tariffs will actually be implemented before making major investment moves. Last of all, for this market update, it would be irresponsible of me not to mention the DOGE Commission. Elon Musk's DOGE is working very hard currently to reduce government spending, decrease government services, government funding, and federal government employment. The big question, of course, going forwards is whether these massive disruptions to the federal government and the business and employment that it does could trickle into the consumer sector, cause increased uncertainty and concern, and potentially lead to a larger economic pullback. Unfortunately, As with the tariffs and the inflation, we just simply don't have enough evidence and enough tangible data to know what the future trend is going to be. With that said, we'll continue to do what we always do, watching the economic reports, watching the markets, and trying to get a good understanding of what information and what data is the most useful and the most helpful for you to stay informed and to be up to speed on the markets. We'll continue to read through the reports and analyze the data and bring you the most important information in an easy to understand format. Join us again next week for our next weekly market update. Thank you for taking the time to join us this week, and good luck.